Hello there, welcome to our lesson number 12 on our series of Introduction to Financial Accounting. So in the previous lesson, we talked about how to prepare the income statement, and today we'll proceed from there, and we're going to talk about how to prepare now the balance sheet and the cash flow statement. Okay, so in this lesson, we will march on the balance sheet, which is also known as the statement of financial position. So a balance sheet provides a snapshot of a company's financial health by simply showing a relationship between what a company owns, which we call assets, and what it owes to other stakeholders, which we call the liabilities. So the balance sheet is simply a financial statement which also includes the shareholders' equity in the business. So here we're going to look at the example of how a balance sheet looks like. Yours, of course, will look different than this, but the fundamental sequence here are just the same. So a closely related metric that's also included in is retained earnings, or the earnings that are not distributed as dividends to shareholders. So instead, that is reinvested in the business to drive growth, pay off debts, and the like. So this helps to maintain a healthy balance and support the company's long-term financial stability. Okay, so we're going to talk about the steps that we have to follow when you are preparing a balance sheet or a statement of financial position. Okay, so the first step is that you have to add up all the assets of the business. Yes. So under these steps, you have going to list out all your assets, including cash and cash equivalents, inventory, marketable securities, accounts receivable, less liquid assets like property and or machinery in that order. So you arrange them in order of their liquidity. So for the sake of clarity, so it's best to display assets in different categories. That is current assets, such as cash, accounts receivable, and inventory. So the more liquid assets, that's why we call them current assets. And then on the other side, we have fixed assets, like property, plant, and equipment, and other assets like investment and intangible assets, which are all less liquid assets. So having added up all the assets, we add up now the liabilities. So as indicated, the liabilities include accounts payables, the amount that you owe to your suppliers, stock of wages, accrued expenses, name but just a few. Okay, so similarly to assets, you should divide this section into separate categories. Stock of current liabilities, accounts payable, short-term loans, and then these are the obligations that are required to be settled within one financial year. And then you talk of long-term liabilities, such as long-term loans and bonds. Okay, so the next step on our preparation of balance sheet, we talk of determining now the shareholders' equity. As we looked at the accounting equation, shareholders' equity represents the residual interest that the shareholders have in the business. Okay, so you need shareholders' equity and retained earnings for the final section of your balance sheet. So the formula for shareholders' equity is as follows. You can just simply extrapolate the accounting equation that with the shareholders' equity as your subject of the formula as follows. So to be assets minus the total liabilities. So the net assets represent the shareholders' equity in the business. Okay. So the balance sheet is called the balance sheet because the relationship between assets, liabilities, and equity must be balanced in that particular accounting equation. So this is best represented by the famous accounting equation, which says assets is equal to liabilities plus shareholders' equity. So at the end of the day, you want to look at the net assets of the business after subtracting all its obligation to other parties. So the statement of financial position or the balance sheet, in essence, is based on the accounting equation. So as you probably noticed, the accounting equation is the inverse of shareholders' equities information. You're just simply changing the subject of formula. Okay, subject of the equation. Okay, so to calculate retained earnings, you look at the balance sheet from the previous period. So you find the retained earnings there, and then you add the net income for this reporting particular period. Okay, so the net profit that you arrived at when you were looking at the statement of income represents an addition to the retained earnings that will be reflected under shareholders' equity. But that is assuming you are not distributing those profits to the shareholders in form of dividends or drawings. Okay, so you subtract dividends, so you have retained earnings for your new balance sheet. Okay, so now we're going to look at a typical example of how the balance sheet looks like, looking at the same company that we looked at when we were preparing the income statement, ABC Company Limited. So we're looking at the statement of financial position, which is as good as the balance sheet as at 31st December 20x5. Okay, so as we said, you have to first aggregate all the assets and then group them in order of their liquidity. So our currency here is US dollars, and our level of precision, we don't have any there. So the number is at is how it is as how it will be it is spread here. Okay, so under assets, we first have for the current assets, and current assets we can have cash and cash equivalents. So cash and cash equivalents, top of cash in hand, so cash at bank. So these are under current assets because they are readily convertible into known amounts of cash. So the current assets, so we have cash and cash equivalents of 10,000, and then we have accounts receivables of 5,000. So these are the amount that customers owe us. Okay, so we expect this to be settled within one accounting year, and from there we have stock or inventory. So this can be in the form of the products that you sell that remain unsold at the end of the period. So that is also under your current asset because they can be readily convertible into the known amount of cash and cash equivalent. So the total current assets in this case, you simply add that one. So we have 30,000 of current assets. From there, we go to non-current assets, and current assets, we talk of property, plant, and equipment. So these are the properties or assets that are used in our course of running the business. So these ones are under non-current assets because they are used in business. We don't keep them with the aim of selling them because these are just used. So the amount that is reflected there represents their cost or the value that can be realized should we happen to sell them. Okay, we're not going to go deeper into that one because there are different models of how you arrive at the value of PPE. And then we also have intangible assets, stock of goodwill. When you be looking at business combinations, when you acquire another business, there is what we call goodwill as an intangible asset. That was also included under non-current assets because this one is not readily convertible into known amount of cash and cash equivalents as well. Again, this one is also well explained in details under business combinations and IFRS 3 when you be looking at business combinations. Okay, So total non-current assets here we have 55,000. So we have both current and non-current assets. Now we can aggregate them. So we find a total figure of 85,000 as our total assets. Now it means we have completed the step 1 of preparation of financial statements. So you will notice that we'll be following the accounting equation where the total assets have to be equal to total liabilities and equity, since we said the assets of an entity can either come from a debt or shareholders' investments in the business. So now let's go to the section of liabilities and equity. We start with current liabilities, accounts payable of 8,000. These are the amount of money that others we owe to our suppliers. Short-term debt, 2,000. Total current liabilities are 10,000. So these current liabilities are expected to be settled within one accounting period. That's why we are grouping them under current liabilities. From there, we go to non-current assets. Current there was supposed to be current liabilities there. You forgive me. Then have long-term debt. As the name itself suggests, it's a long-term. It is not expected to be settled within one accounting year, but rather after a long time, for many years. So total liabilities, we add non-current liabilities and current liabilities, a total of 35,000. From there, we go now to shareholders' equity. Let's take shareholders' residual income. So we have common stock, ordinary shares. That's the very first initial investment in the business, it's 20,000. And then we have retained earnings. These are the profits that have been reinvested in the business. Now they form part of the shareholders' equity. So profits increase shareholders' equity. That's why retained earnings are classified under shareholders' equity. And the total shareholders' equity is 50,000. And the total equities and liabilities is 85,000, which is equal to the total assets, keeping the accounting equation in balance. So this is how a typical balance sheet or statement of financial position looks like. Okay, so this is how it looks like. Then now let's look at the key components that we've discussed so far. We talked of assets. These are simply what the business owns. We talked of cash, accounts receivable, inventory, and property. And they talked of what the business owes, that's liabilities, accounts payable, loans, and debt. And then he talked of equity, so net worth or owner's claim, retained earnings on stock. That's like examples of things that are classified under equity. So in simple terms, the balance sheet is simply a full demonstration of the accounting equation. It simply shows you how much the business is worth by expressing all the assets and liabilities that it owes to other lenders. So that is what I had for you under this lesson. Lesson 12. We were simply talking about how to prepare a balance sheet or a statement of financial position. So thank you for watching, and don't forget to like and subscribe. And check out for our next lesson where we'll be looking at now the statement of cash flows in lesson 3. If you have not understood very well, you can always play back the video, or have questions, you can put them in the comment section. Thank you once again.